combine the November working group into, the October working group into November, really based on the fact that we don't quite know how Sandton is going to be impacted. We are a little bit concerned about it, so it just means we might have a more meaty November working group versus having one in October and one in November. The other thing is I have received some requests from the guys in the commodities market to please move these meetings to the afternoon. We sort of had them mid-morning trying to let you guys have the market open, come in, and then at least you're in the office for the end of the day. And I do apologize. I think that was a bit of oversight on our side. Their market closes at 12. It's a bit difficult for them to be here during those core hours. So we're going to try and look to reschedule these sessions, and I am potentially going to look to reschedule the November one. So we'll use that as the first one to try and sort of make them from about 1 to 3, because again, or I need to make them from 2 to 4. Again, I'd like to just be conscious for those guys who need to then get out of Sandton again, but we'll try and find a time and notify you with the update for the November session as to when we'd like to have these. Any other suggestions that you do have, please do forward to us, so we will try and accommodate everything as best as we can. It's not going, Sekle. Sorry. Advance. Okay, that's just, remember, a reminder of our trading gateways, deal management stuff as well, the clearing stuff, our reference data. These are the standard diagrams we just include for you for reference. A little bit more detail around the deal management and the clearing and the back office functions and what you're going to get from which system. A reminder of everything we've covered in clearing and risk management to date. The blue dots. It would help if I push the right button. So the blue dots are really the things that we're going to pick up on today, margin methodologies and the risk monitoring. And that's it. I'm going to hand over to Martin. Terence, everybody, sorry.
Morning all. I'm Terence Simon. I head up risk here at the JSE, and really what we're going to cover today is exactly that, pre-trade and post-trade risk management, focusing on the kind of controls that we have that ITaC will bring about within those two spaces. Really, what we're going to be doing and what Martin's going to be covering is an overview of how the trade enters our system, how the trade enters into through MIT into Cineba, and what are the pre-trade controls that are being put in place, and how you can control your risk before the trade even is cleared. Thereafter, we're going to look at some of the, well, we are looking at some of the principles involved in how we have looked at what are the guiding principles in how we've looked at pre-trade risk management. We want to protect the market integrity, ensure that the market is of sufficient quality, providing flexibility, minimizing the administrative overhead, and enabling a competitive advantage for software guys to come in and provide meaningful risk management tools. So really what this means is that pre-trade risk management is broken down into 3 levels. What happens at the trading member level, what happens by and for the clearing member level, and what happens right at the center at the exchange. And each of those areas, Martin will explain to you, have got different levels of risk management and different controls in place for different purposes. And so I'm going to hand over to Martin now, and then thereafter Willem will come in and explain the post-trade risk management tools that are being put in place as part of ITaC.
Thanks, Terence. Good morning. As discussed, so basically what we're going to be looking at, pre-trade risk management, orders coming into the Millennium system with a specific focus on the trading side. We'll quickly go over what exists at the member level, which we sort of require members to start having a look at on pre-trade risk. This is a sort of a guiding principle from our side and what we expect you as the JSE to be able to do on your side. Then we'll look at what the exchange will offer you. So that's going to be more of a blanket approach to what is offered in the system. It's not going to be vastly specific per member, but we'll get into the detail. And then obviously the clearing members will touch on briefly at the end of going through the detail of what is to offer. So To go into a high level, we'll have the trading members. What the trading members are meant to be looking at, so this now goes into the software, specifically software providers for trading members. You're going to have to look at orders, trades, permissions, and price movements, position limits, proactive monitoring, trader limits, firm limits, message rate, and the obligations to clearing members. Now, how they lead into, just want to pull up the slide for the exchange. Already, you can see that orders, you need to be limiting these orders on your side already. So the trading members are key in determining who can trade, what sort of limits, what sort of values, what sort of volumes on their side already. We will obviously be putting in order limits at the exchange level, but they're going to be higher level order limits. They're going to be order limits as maximum order limits that are not going to be specific per trader or per comp ID as in an interface user. So the connection that gets established between us and the trading member. So order limits are quite key to be done on a trading member level already by the software providers. Trades, again, we'll be looking at trades and having trading limits. There'll be specifically for the off-book trading, we'll have specific limits that come into play for price bands that have been breached because of it being a reported trade. But trades must also be permissioned on the trading member level to ensure that certain trading doesn't exceed normal volatility auction or price banding that exists in the system. In the system, we will have proactive monitoring on price limits. Volatility auctions, which we'll get into in a bit detail later, will exist. However, it is a prerequisite on the trading member side to ensure that these limits do not get breached on a continuous basis. So a protective limit on what type of trade or how far away the trade is going to be executed needs to exist on the trading member side before it even hits the exchange. This includes, but is not limited to the fat finger problems or clients booking potentially a buy but wanting a sell and cleaning out the order book on either side. So those are quite important to note as well. Permissions, we will provide permissions on a high level at the exchange. So we'll put in certain limits on who can trade on what markets. Just as a high level example, if you trade in the EDM market, you're a trader, you might not be able to trade in the CDM market, for instance. So those kind of permissionings we'll put in. However, limits on what type of instruments potentially within these markets needs to be done on a trading member level. So again, these are all very, very detailed trading member limits and permissions and so forth that you need to be very aware of and cater for as software providers. The price movements, which we spoke about, is ensure that price limits aren't breached. Yes, of course, they can be breached if a share is trading or if an instrument is trading in a quite volatile range, but it should not be the norm. Proactive monitoring, we expect a lot of proactive monitoring from the software / trading members then because of how a client is trading, what shares he's interacting in, what instruments he is dealing with. So that is also going to shift quite heavily onto the trading member side. Firm limits will be on trading members as well. So across the board on a firm level, you need to be interacting potentially with your clearing members, which we'll get into in a few seconds, to see that what limits are you actually enabled to trade, what positions have you got open, and what is your clearing member going to stand good for. Message rates, the JSE will, in the message rate throttling section under the exchange, will look at as well. However, we do require you to look at this message rate that we impose on you to be imposed on the trading member level already. So even though we are going to be message throttling you, should you be exceeding certain rates and so forth, that needs to be done before it hits us, and only extreme cases of really, we will start limiting you on those rates if and when there is a complete rogue system that is going past, or it's really protective measures rather than the norm where we should be rejecting orders, and we'll get into that detail a bit later. Adding in the clearing member and this blue slide at the bottom, so clearing members to trading member agreements with risk limits and obligations. So the clearing member needs to be in very, very close contact as already with the trading member to see what sort of limits you can actually impose on your trading side. To go into the clearing member details, we've covered this in details, the drop copy of orders and the copy of the trades. So a clearing member will always have a view up to probably within a second, if not faster view of what their trading member is up to at any given second. So from a pre-trade risk advantage perspective, that's giving the clearing member already a complete view of all of his trading members and their positions even before they're executed and their potential executions. So risk management on a clearing member level becomes also very important on the pre-trade side, because they have this view into the market without having to have an extra link into the trading member, come straight to the exchange, and those were the sessions we covered in the last previous sessions. The clearing member needs to also have the ability to cancel orders, monitor trading member exposure, and there needs to be an agreement with trading members and the obligations to the clearing members. So that's resting on the clearing member side, and then you guys can see how that will lead into your software development. All right, so that's a high level of what we are going to be discussing, and in the middle we then have the exchange in green, what we're going to be talking about in detail. Are your order limits and trades, your permissioning, your controls, your proactive monitoring, and your message rate throttling. There's also the JSE rules and directives and the JSE services agreement. The JSE service agreement will be entered into between the trading members and clearing members, well, between the exchange and the trading members or the clearing members. It will govern certain responsibilities that the members have as well. So there's going to be a whole lot of detail in the services agreement which members need to adhere to already. So again, from pre-trade perspective, you are contractually bound to do what is in that agreement. So it's very important to note that. The rules and directives for the derivatives market are being updated to be more stringent and more clear on when certain activities can happen. This includes order rates, order management, trading from the direct market access point of view, what kind of what trading members are responsible for, what the exchange will be responsible for, and this will be rolled out throughout the project. And you'll get a view of those, obviously commenting on it as is standard practice when we do changes to the rules and directives. Our operational requirements will also come into play. So this will include things like the connectivity into the exchange. How do you connect in? What type of services do you use? Software conformance and accreditation, that covers. Again, we'll get into these things in a few later sessions. Software accreditation will be a pre-trade risk limit because we will mandate a certain level of software conformance, as you are aware of already in both of the markets, the derivatives and the equities, that a software has to comply with before it will go live on the trading system. So there again, we are pre-trade risk managing that no rogue system or any strange activity can happen, as we've done sort of minimum requirements for you. The accreditation side will cover shared infrastructure providers, software providers, and your NSPs that will feed into, again, a certain minimum level of compliance with JSE standards and international standards to make sure that no unnecessary risk is being introduced into the system. All right, so that on a high level is where we're going to be going into our presentation today. So we've covered most of these sections already, and let's go straight into market limits. So what we'll have on a market level, what we're going to be talking about is just exchange specific limits. We're not going to be talking about what is on the trading member side. These are the examples of what the JSE on a market level will be offering. So we'll have maximum order size. Effectively, all orders entered by an interface user, your comp ID, will be validated against the specific maximum order size. So you won't be able to enter anything above this value anyway, and that's how we are going to make sure that maximum order sizes are not breached. If the volume is obviously greater, the order will be rejected on the gateway level with a rejection message. We'll be doing this on the buy and sell side of a quote. Remember, a quote is just a single message that gets entered for a buy and a sell order. So we'll be looking at maximum orders like that. Similarly, we'll be looking at the maximum order value. Again, all orders and quotes will be rejected should this limit be breached. So we will reject the order outright on the gateway level. Bids and offer of a quote will be separately validated, and on a quote level for the maximum order value, just as a note, the bid side will be validated first. Should that pass, it'll go through. Should the sell side then come through as well, it'll be rejected again on the gateway level. Okay, then how we are calculating these values, just as an example, when we are moving into an unpriced order, so a market order, we are looking at this will be during regular trading, pause, or a CPX session. So CPX is just your closing price cross session. These sessions will be explained in a lot more detail when we move into the detailed design of the system in one of our later sessions. So we will consider these, the contra side and the best bid offer will be considered as the price of the order if we are looking at any market orders that come in. Should this not be available, we're looking at the dynamic reference price, your DRP. That dynamic reference price is usually your last traded price, which the system will reference as its most recent price to refer to. If these are not available, the order will be accepted by the system without performing any validations. So it's important just to note that. Then again, when computing the order value of an unpriced order entering during an auction call session, we'll be using the indicative auction price available at the time of the order entry, and we'll consider that price. So indicative auction price will be your price using the volume maximizing algorithm to see if this auction uncrossed at this second in time, what would be the value that we'd be uncrossing to. So we'll be using that value to determine if we accept or deny the order, the total max order value that is received. Again, if it's not available, the DRP of the instrument will be used, and again, in the absence of both, there will be no validation. The same will apply to parked orders undergoing election. So what that means is if you have a stop order or a order where you've put in a certain time of force where it should enter into a certain time period or certain session or so forth, we'll only start looking at that order and validate it when it gets entered. So what you'll hear us speak about sometimes is entering the main container. So what that means is the trading engine has a main container where all the orders sit, they're active orders, they're live on the system. Anything separate to that are orders that are waiting to be injected due to any validation that might exist on them. So once that validation kicks off, a stop limit order, anything like that, at that point in time, we'll do the value calculation. Okay, moving on to permissions for the trading engine. Trading members will be permissioned at a market level for each interface user. Again, your interface user, your comp ID, is what you'll be connecting with. It's your logical connection to the exchange. Traders do not connect to the exchange. So your traders will feed into the comp ID, which has the connection established. We'll be setting these on the three gateways, which will be your equity market, your equity derivatives, currencies, and interest rate markets, and commodities and bonds. So if you remember back to some of the previous slides we've done, you'll have three gateways that you're effectively going to be connecting to, different IP addresses and ports. So on that level, we are already preventing anyone that is not permissioned, for instance, for the equity market, logging into the similar gateway and trying to trade on the equity market if they are an equity derivatives member, for instance. So we'll do this on a fairly high level, on a market level, because that's where most of the permissioning sit. We permission traders to be trading on market levels and not necessarily by instrument level from a market perspective. The interface users and comp IDs will be assigned and created and permissioned by the JSE during the enablement process, which we'll get into in a lot more detail closer to the time. Effectively, this is an interaction between the trading or clearing member and the JSE, and you'll be telling us exactly how many comp IDs you need, what markets you're going to be connecting to, what order rates and so forth you need, and we'll validate all of these steps quite closely, clearly, and then provide you with a documentation that stipulates exactly which comp ID and naming convention and so forth you'll be connecting with. So already here we're limiting you to not be able to trade across any market unless we've specifically been told and instructed by the trading or clearing member and have permissioned that on the JSE side. Further to this, we're going to be doing IP address validation on the system on connections for logins. So that means if you've given us an IP address you're connecting from and it does not correspond to the one you're actually connecting from, the system will reject you outright, not even let you through the gateway onto the trading engine. So again, this will allow you to do risk management, potentially on a level of using different IP addressing, different sites and so forth on that level. An interface user comp ID for a trading member can be provided to a clearing member on behalf of the trading member to cancel orders in exceptional circumstances. So what we're looking at here is, if you so wish to do so as a trading member, you can provide a comp ID that belongs to your firm, has its own IP address and own setup according to how you've wanted it to be set up with permissioning and so forth. And you can provide that comp ID to a clearing member that is clearing on your behalf. In the extreme case, potentially, where the clearing member now logs on with that order, with that comp ID and pulls all your orders or does deal management on your behalf. This is it's not something we are mandating. It is an offering that is there. We are going to allow you as a trading member to make the call to say if you want this available to your clearing member to at any time log in and do deal management. What you have to note, however, is that the control potentially rests with the clearing member, because any cancellation that gets sent in, we will not be doing any special permissioning on that comp ID only. they'll have the ability to mass cancel orders on a instrument, segment, comp ID, and firm level. So they can really do deal management very effectively in the event of any crisis situation or so that they deem fit. But that, again, is going to be a contract between the clearing member and the trading member, and specifically we will only take that instruction from the trading member, because that is the legal agreement the JSE will have with the trading member as part of the JSA, the JSE Services Agreement within there. We cannot take any instructions from a software provider or from a clearing member to create this comp ID and so forth. So the dealings will always be with the member directly. Obviously, the software providers and shared infrastructure providers get involved quite heavily when it comes to the technical bit, but sign-off will always be needed from the trading member perspective. So that speaks to the last bullet to just say trading clearing members should, however, note the consequences of allowing this. So have a look at it, think about it maybe in a bit more detail. We will be there for consultation closer to the time when we have our testing environment as well, and we can do the test setup and see how it affects you. But it is an option available for you. Then moving on to market maker protection. This is a fairly detailed section that we're going to be offering. If you are selected or set up in the system as a market maker, there are 5 types of protection limits that we'll make available to you, and they'll include a value volume limit, a fill limit, and then a value and volume delta limit. We'll go into each of those in a bit more detail and what they mean. Basically, on a high level, it is, as a market maker, we understand that there are certain obligations or certain needs that you need to fulfill in the market, but should certain limits or the market move vastly against you and so forth, these limits are there just for protection against a market maker. These limits can be set up in various ways. So we can set them up on a segment for all instruments. This is only for the futures and options. Or we can set it up on a segment for futures or options, per underlying and all instruments, or per underlying for futures or options. So there's various combinations that we can set these limits to, and you'll see in the calculations, the detail we'll get into, a value limit will, for instance, apply for, if we've set it up on its futures and options, it'll add the two together, and that will be your limit on how much value can potentially get put in or executed on a market maker level. Okay, so monitoring protection limits is the system will monitor whether any of these protection parameters of the particular user are breached for every execution that happens for the assigned instrument. So we're talking about executions. Yeah. Example is, if the particular instrument is assigned to the user via an underlying, then any executions for this instrument or any other instrument with the same underlying within the same monitoring period causes the values being monitored to be updated. So what we're basically saying is here, how we've set you up, it could be on an underlying or an underlying and instrument definition setup. And we'll get into all of that detail closer to the time when we have the test environment and we can actually show you the details. We have a certain time period where we're going to be monitoring for certain values. So it could be for the whole day, it could be for certain lengths of time, and once that is breached, it will result in certain actions being taken. We'll get into the slides. Again, then, if the particular instrument is assigned to the user via a segment, then any executions to this instrument or any other instrument in the same segment within the same monitoring period, again, cause the values being monitored to be updated. So each time there's an execution, depending on the setup, according to these various principles, you'll be monitored across that time. We'll decide some time frame that will make sense. We'll engage with the clearing and trading members on that to get more specific values, and valuation will basically and calculations will take part in that period. Right, then in a bit more detail, if during a monitoring period the calculated protection values for a market maker for an assignment exceed any of the specified limits, again those 5 we're speaking about, all orders and quotes for the particular user belonging to the following categories are automatically cancelled. So that's how the limit will then kick into place and protect the market maker by removing orders that are already sitting and are open on the market. So for example, an instrument is in a particular assignment. If a protection limit is breached for a segment, the orders and quotes for all instruments belonging to the specified definition, that segment, will be cancelled. And if a protection limit is breached for an assignment via an underlying, all orders and quotes for all instruments belonging to that underlying will be cancelled as well. Then instruments that have legs which belong in particular assignment. We talk about legs. This can be your implied orders or through your strategy trades that you're trading. The protection limit is set up as an example here using instrument ABC as the underlying and the options as the instrument definition. So that's your limit that we've set you up as an example. The market maker has active quotes for some of the options based on ABC, and has submitted quotes for a strategy with the ABC as a leg. When the volume limit of the market maker for ABC-based options breaches, all his orders and quotes in ABC-based options as well as strategies with these options as legs get cancelled. So that's just an understanding of in the detail when we do publish our API settings and we get into more detail, probably be a market notice on this, or not a market notice, a user guide on how this will work. We'll be able to engage with you directly for any questions more specific to this, and in the test environment this will all be able to be tested. Okay, so this functionality is applicable to orders and quotes submitted as single quotes as well as quotes submitted as mass quotes. Mass quotes obviously just being one message that comes into the system asking you for different positions in different books and order books. Implicit trades, this again, I think they're called, or you can refer to them as ghost orders currently in the market. Anything that comes part of a strategy implied in, across, or out, these are all going to be applicable to these limits as well. So you're really covered across all of the sort of order management that you're busy doing in the system by having these synthetic instrument trades and leg trades included into the calculation of this value, volume, or fill limits. The protection limits are evaluated only after each aggression. So it means that actually an aggressing order may take the actual exposure above the threshold. But after that, if there's any remaining execution, your order will still be cancelled and all subsequent. However you're set up, they will all be pulled. If a threshold limit is exceeded for a market maker in the middle of an auction, the planned auction is completed, no orders or quotes are cancelled. But once we have completed the auction and there are any remaining quantities again belong to market maker, they are cancelled if you have breached your volume, value, or other limit that we've implied on you. When an incoming or aggressive quote of a market maker executes and breaches any market maker protection limit during an execution, the system cancels all relevant orders and quotes of the market maker, including both the sides of the aggressive quote. So that's just really to recapture again what exactly this market maker protection is going to be offering you guys. Going into the limits, I won't be spending too much time on these. You can look at them in your notes, but very simple. Value limit is just the maximum gross value of the orders and quotes that are allowed to be executed within the period. Again, it's along that period. And total value summing up the trade price multiplied by trade size and the contract multiplier. Similar to the volume limit, the volume maximum gross volume we've set up will be the value if it exceeds the value in your total sum of the traded size and contract multiplier. The fill limit we'll be using is the total number of executions that are allowed within the monitoring period, and this will be specified again only on an underlying and instrument definition segment or for a segment and instrument definition. Your volume delta limit is defined in absolute terms, and you'll have your applicable options instrument formula there where your buy call volume and sell put volume subtracted from your buy put volume and sell call volume will be summed. And then your applicable futures calculation is just below that on your delta. So that's just how we are on a high level going to be calculating these limits. Again, on your value delta limit now, it's also defined absolute terms, and again, similar to the volume delta, just on a value level. Okay, then moving on to a different topic on the pre-trade risk management. We are looking at cancel on disconnect, applicable on the interface users. What this functionality will provide you with is allowing you on cancel on disconnect or logout the ability to pull all open orders or quotes depending on how you've set up the system. So you can set this up in various ways. You can say do not pull or do not cancel any orders whatsoever. You can decide to pull all orders, or you can have the option to exclude your good till date, GTD, or your good till time, GTT, orders to remain in the system. This is the logic here really is about clients that have been sitting on the order book for a whole long time. They've almost reached top of the book and so forth in priority, lots of guys behind them on the same price, and then there's a technical issue and all orders are pulled and they have to come back into the market at a lower level. So you can decide to keep those good till date and time orders in the system. This is really for day orders and any trading that is happening intraday where monitoring of the orders is quite key in very low time frames rather than from a longer term perspective that you put them in. So as we're saying, it allows users to be confident that are not sitting in a moving market whilst having no connectivity, and it will cancel all active orders. Now we have to set this up on an order level. How you set this up again will come part of your enablement process. We will be asking you if you want this enabled or not, and it is highly recommended that you do enable this from a trading member perspective, because should you have any issues that you cannot actually access your system in any way to cancel an order, mass cancel an order, do any order management from anywhere in your systems, the simple fact that you can disconnect or log out will pull all open orders, and you've got time to come back into the market, figure out your connectivity and so forth, and have peace of mind that there's nothing sitting on the book that might affect you in extreme ways as the market moves in the time that you're out. We offer this, and for that reason, we offer this disconnect delay. So it's specified in milliseconds, and you can define on when you get disconnected or logged out, how long the system should actually wait for you to come back into the market before it pulls the orders. We normally see on the equity market currently already guys using this to set it at slightly higher than only a few milliseconds, purely because often we see connections dropped and reconnected, and then there's no need to pull all your open orders. Just to explain this in a bit more detail, the fact that you have to specify this on an order level is very important. So you set up your comp ID to state that it is enabled to do order management on your behalf should you be cancelled, should you be disconnected or logged out. However, every single order is still able to be told whether it needs to follow that combination or whether it should just ignore it. And it's by a simple flag on the native trading message that you'll see that is a cancel and disconnect, yes or no. If you do select, so in this table, I'm just going to show you how your mass cancel and disconnect or logout is enabled from an enablement setup view. So in the gray column, your user activity. So you will specify the value, whether it should be canceled or not, and then actually the outcome and result of the system when you've done this. So your comp ID is set up to be able to cancel and disconnect within the first line for yes. You've entered an order that says do not cancel this on disconnect. Obviously your quote or order will not be cancelled when you do disconnect or log out. This time your comp ID is not set up with the functionality, and it blanket rule applies should there be any setup on a comp ID level or interface user level with none of the orders will be cancelled, as can be seen on the far side. Even though you've entered in scenario 3, you've entered the order to say yes, please cancel it on disconnect, it will not disconnect it. So it's a basic setup to do it once correctly, to set it as a yes if you do want the functionality enabled on a comp ID level. And then the obvious cases on yes for the comp ID and for the user specified, the order will be cancelled. And if you've not set anything, we are going to assume that it is not cancelled. So it's not a flag that is a required field, but if it's received by the system, we will default it to no. So if you haven't set it, this is an implied no and no. And that's how it works with the cancel and disconnect. Just another extra pre-trade risk management that can be implemented on the side of the trading members. Then moving on to input message rate throttling. This is just a protection for members, for the market, and for the JSE systems to ensure that we are not having concentrated risk across any one connection or any one firm or member that might adversely affect the trading engine. Obviously, we'd love to be able to provide a system that can handle 1 billion orders or so a second and so forth, but obviously then costs to us and clients and everything will go up. So we have built a system to the best spectability of what we have seen in the market. We know it can handle very active sessions during times of need. It will be able to perform at a very high order rate level. However, what this limit is really looking at doing is if there's any connection, a DMA connection potentially, your own connection, an algorithm that sits somewhere that has now gone a bit haywire and it starts sending or feeding in a whole lot of messages that you're not potentially aware of or that you might not want the system to accept, we will be setting this at a comp ID level again. So how this will work, it will be managed by the exchange, again, part of the enablement process when the comp IDs, i.e. interface users, are created by the firm. So again, this is part of the engagement between the software provider / trading member, where we'll say, you will state exactly how many orders per second you'll be looking at on a comp ID level. So it's set on a user level, interface user ID, and the inbound messages are received by the gateway up to that limit for the interface user on a full second. So if we explain this just quickly in a picture, you'll see all of these orders, the arrows just represent orders coming in. We're looking at a time frame here at the bottom of 13, 1:15 and 10 seconds and 0 microseconds after that, and this whole period is spanning basically one complete full second. So any order that comes into the system the system will start counting this order, and if it breaches the limit of what we've set, let's say 100, and these orders here, the fat black one there is that's your 100th order that's come, it will be accepted by the system, and any subsequent order will just be rejected before this time period of the 1 second is over. Yes. So how we've set it up currently in the equities market, we're going to be looking at doing a similar approach for the derivatives market. However, it's not defined yet exactly on what to do, but we're looking at about 300 orders a second per comp ID, but its standard setup will be 100 orders per second. They'll be looked at in the same way. It's a general limit that we're implying. It's already in the equity market, it's a set limit, so everyone gets 100. You can ask the exchange to drop that down. That's also a possibility. You can ask for an increase. We've set it to say that any firm can have 4 comp IDs at 300 and the rest at 100. We look at your trading activity, your noise, any adverse system issues that you might have caused us or yourselves in the past and so forth, and then we are open for negotiation on any of these orders. So it's a blanket limit that's not hard and fast set, because we obviously have to look at special requirements. 4 across the board. Yep. Right. But that again comes to the point where we are looking at, we'll really be looking at what are you needing them for, how you've been interacting in the past, have we got special examples of that you have exceeded this limit, and is it really necessary? So we won't be opening any of these orders just because there's a request coming and there's a rule saying, no, we are very busy. We'd like details, we'd like proof to see it's really there. And this again goes to, so this is the risk, pre-trade risk limit also we are putting on at the JSE level. Again, this will reflect on the member level to make sure that any inputs are throttled before they even hit the trading engine. So your systems should be designed in such a way that you will actually never hit this, let's say 100 level, so that you breach it out or you just span it out across the seconds, because every rejection that you will receive, remember, will get an execution report back, and not a reject message, sorry, stating message rate exceeded. So for these 3, you'll get 3 messages back. Again, obviously, increasing your number of orders that are flowing through your line, increasing your bandwidth potentially, and if you're already in a constrained bandwidth environment, this is just going to exacerbate your problem of sending in orders in peak times, rather split them across those seconds. Okay. So just to recap that in your notes is, again, the orders that are received that breach this limit will be rejected with a reject message. It won't even hit the trading engine. So that's, again, how we do pre-trade risk management for our systems as well. It'll be rejected on the gateway level. So it won't affect latency on the trading engine or have any adverse effect on the trading engine. It'll be stopped on the gateway level already. So point 2 we just spoke to, the message rate should ideally be set on your systems already before it hits the JSE at a lower rate or very, very close to that rate, so that you never actually do breach the order rate that we've set. What we can do is we have the potential to have interface users and comp IDs locked due to excessive breaching of the throttle rates. So you will be rejected on this slide. Again, you'll be rejected 3 times. We have a limit in place that states that if you exceed this limit a certain number of times, so within a certain period you are being rejected too often, you actually get disconnected from the system, because we are seeing this as an inflow of orders that is way past the limit that you are actually allowed to be trading at, that we've in fact asked you on the enablement form to adhere to, and we see this as there are potentially system problems or any activity that is far from normal, and you will be disconnected from the system. Again, we'll get into that detail a whole lot more when we go through the examples after you've had access to the testing environment. Then moving on to the kill switch concept, we have the ability to disable access to trade. So JSE market operations can immediately disable access on an interface user level. It's literally a right-click approach for us. So should we have any inkling through our market surveillance that we are doing, or any of our active monitoring where we are looking at order rates and we're seeing that anything is breaching a certain level that we are not comfortable with, we have the right and the possibility to literally disconnect that and lock that comp ID out. And then there'll be a discussion between the trading member and market surveillance and the market operations team to understand what happened at that level. So that's again a risk where we do have the ability to do kill switch. You can automatically log off all interface users with one logout message as well. And our team has the ability basically to do this on a user, trader group, or trading member level. So you can ask us, you can actually phone in and say we'd like a certain user, now that could be a comp ID or a trader, to be restricted from trading because there's in some activity that you are not fully aware of or in control of, or you need us to just suspend that. And on the same side, we can lock out a trader group if we see a certain group misbehaving or breaching the limits that we have set in place. Then moving on to price bands on off-book trading. So we're introducing a concept of price banding on off-book trades as well. How this will work is in the event that an off-book trade breaches a certain price band, an alert flag, which is going to be called PB, price band, breached, is sent on the trade capture report message. So when you connect to your PostTrade gateway, you'll be receiving this flag if you have submitted an order that has breached these price band limits, which we'll be publishing on your certain order that you've sent in to trade. It will be a notification. It will be sent to the clearing member if your clearing member decides to be connected to your real-time copy. However, that flag will be carried through our downstream systems and into our clearing system as well, which will notify the clearing member that one of its trading members has actually done an off-book trade that has breached a certain limit as set by the JSE. The price band being breached, however, does not, it notifies surveillance, market operations, the clearing member, the trader that has done it. However, the transaction will still go through. It is still a valid trade and can happen. But should JSE surveillance contact you and so forth, you may have to cancel the trade. But it won't be a price band where we stop the trade from happening. It'll just alert you that this trade has actually happened in the market. We feel this is a lot less restrictive and will create a lot less management and overhead on both clearing, trading, and the JSE side. Then moving on to circuit breakers, very similar concept than the off-book trades that we've just discussed. Circuit breakers will be introduced, which is looking at two types. We'll have the static and we'll have the dynamic circuit breaker. The static circuit breaker can be configured to refer the previous day's closing price or the last auction price. So what we'll be looking at on the static, we'll get to a slide just now. It's a broader limit. It is going to be a limit that says over a total market move for the day, we are going to introduce a limit that will state that this instrument may not breach that. And if it does, we'll move into a volatility auctions just to create some order in the system again and say, do we really want to breach these limits? Or are we going past this price? The dynamic reference price makes a whole lot more intuitive sense potentially. It refers to the last traded price that we'll be looking at. And if you're breaching that limit from a last traded price, it will also kick off a volatility auction. So the more restrictive limit will always take precedence. Obviously, the static limit will be a lot broader and the dynamic limit will be a lot smaller in range. We'll get into that picture just now. So we'll set these on, these can be set on a percentage or a static value. We're looking probably more at implementing these on a percentage level. It makes more sense than on a static value. Simply because these will be carried over from day to day and static levels change and obviously the percentage won't be maintained at a constant level. This will be applicable to all orders aggressing the order book with matching potential on a pre-execution basis. So even before this limit is breached, this circuit breaker will kick into place. So you'll trade up all the way to that circuit breaker and then it will not exceed trades that might breach the circuit breaker. Breaching orders trigger a volatility auction, which allow all users to manage their orders. There will be a short time of sort of an auction. Deal management can take place, but no, or rather order management can take place, but there will be no executions happening. Volatility auctions will further be subject to price monitoring extensions. So if an extension has already been, if an auction has started, we'll be looking at, is this price actually very far out of the market, and hence an extension of a couple of minutes or so forth can still apply to say, are we really sure that this instrument should be trading out of these limits, yes or no? And those could be extending the volatility auctions and market order extensions, meaning are there any market orders only on the system? This normally happens if the book is filled with a whole lot of market orders, no limit orders. The system's just waiting for maybe some people actually do want to pull these orders and just want to make sure that the reference price after this volatility auction is calculated is actually useful and worthwhile for the market. So just to go into an example, quite a picture a lot of you should probably be used to already. Looking at the static price as the red dot. So in the morning, let's say we've opened the auction and that is the first trade of the auction. That is a static price, and we'll be looking at, the example is 10 up and 10 down. That's going to be the range for the static level. You'll see this line is showing that that's the range that this share or this instrument or this option or so forth can trade throughout the day. The yellow dots are your dynamic threshold limits. So they are a lot smaller in range, and we've chosen the 5% limit. So as this trades, as you can see, that the red dot moves, and those are the trades, the dynamic threshold limit keeps being updated, and it will not be breached in the 5% period. Now, if you look at the last trade, that volatility auction that takes place because of the breach is on a static level. So because it's breached this 10% limit for the whole day, an auction will take part at that point. Even though this instrument has traded further than the 10% and even the 5% limit for the day, it has not invoked as a dynamic threshold, so a dynamic reference price auction, because between each limit, you can see this price has never moved more than 5% from each hop, which is the yellow dot representing its limit. But only once it breaches the static limit, we hit a volatility auction. So the price can move throughout the day at various intervals between the static price and never be breached, or the dynamic price is really more the fat finger problem, the real big market moves coming through, or someone putting in an order trying to be on the sell or the buy side and getting both of them confused. So quite a simple concept really, and that again to avoid any trading in prices that are not actually meant for, the members not actually meant to be trading in. Okay, then a proposed limit for execution limits, similar to the price bands that we've put in place and the circuit breakers just discussed. We're going to put in execution limits, and this is defined as a percentage or tick variation from the reference price. Again, we'll choose either or. Probably for this one, we'll be doing tick size. Now, what this means is on this level for execution limits, we'll be saying that you can trade up to a certain level, execution price, and that is where the cap will happen for the day, and we will not be trading past that limit. It's another pre-trade risk we're introducing, similar to what's on the commodity market at the moment. Okay, then briefly discussing the clearing member risks, just to go into detail again from what you've seen as what the exchange will offer, and linking that back again to between clearing member and trading member. Going into the drop copy of orders, ability to receive drop copies of all orders. Again, the clearing member will receive all of the orders that a trading member performs if he wishes to do so, and can do pre-trade risk management on that level already. The same will apply on trades that he receives, all executions. He will see the positions immediately on that and doesn't have to wait all the way through the real-time clearing system, even though that will be close to real-time as well. But he can get that directly from the exchange already. An interface user and comp ID for trading member can be provided, like we discussed. So clearing member has the ability to do order management on a trading member's behalf. Again, that's a discussion between the clearing and trading member, should they wish to do so. And the engagement with trading members on behalf of who they clear to ensure that trading members enforce necessary pre-trade risk controls. So the clearing member has a big part to play really here as well, to ensure that the trading member of what we've discussed in the first few slides are being implemented, and they're actually doing pre-trade risk management on their side adequately to meet the requirements from the clearing member. The monitoring of trading member exposure through real-time messaging from RTC is also available to the clearing members. So through the new Cinema, the real-time clearing system, you'll be able to do that management as well. Okay, and then we'll move into, if there are no questions, move into the post-trade risk management monitoring section. Yep.
set up if we go mail through a file on setting up the limits, talking to customer support, or having an API to set up those limits? Has there been anything set on how that's going to be set up?
So we're going to be setting the value limits. We'll
Yeah.
set up from a broad perspective as in market limits. So we're not going to be setting up the value traded limits from on a specific user, trader, nor on a comp ID level. We see these as being they're quite detailed, specific to very low levels of trading, low levels of trading. So that is a clear requirement that will be shifting onto the trading members to show that it's on that side. So
there'll always be pre-trade risk management. That's where all that limits will happen. Okay.
Yep.
Okay. Cool. Thanks.
Okay. If that's it, I'll be around later for some questions if you need to. Otherwise, we'll go through the post-trade risk monitoring. Thank you.
Before we move on to maybe just post-trade risk management, you guys have received a lot of information here from Martin. Thanks, Martin. That was very comprehensive. Please go through your packs. Please go through the slides. Digest it. Think about what the implication is for your business. Think about the implication for you guys going forward, and bang through any questions to us, and make sure we cover those. Pay particular attention also to slide 11, where we talk through the principles of pre-trade risk management and what we're trying to accomplish and how we're trying to accomplish it. That's really driving the way that we've made the choices, as you mentioned, where those limits are being set and how that's taking place. So please do take your time to do that. Willem, if you'd come and do post-trade. Cheers.
Good morning, everyone. So Martin has just taken us through the pre-trade risk management, which is primarily focused on MIT. What we're looking at now is if we move away from MIT, where the trade has happened, now we are in the real-time clearing system, or RTC, and our major focus here now turns to margin. So that's the main difference where we are now. So what I'm going to do just before we have a short break is just take you through some of the risk monitoring aspects of this. So the main value add from our point of view is the intraday risk monitoring. What this allows us is to publish a message that contains all of your risk numbers related to your margin call as trading happens, as prices get updated. This information is then available to your trading members and the clearing members. Like I said, it's available on an eMAPI message. And what we publish here is your initial margin, your additional margin, variation margin, the value of the collateral, as well as the indicative call. And when we talk about the indicative call, that is the value of your margin call that would have occurred if we had to call margin at that specific point during the day. We also call it indicative just because it might not be 100% correct, because some of the reference data might not be available for instruments that was created during the day. So that number would then tend towards the margin call that you would get at the end of the day when the full margin call run gets kicked off. If we look at initial margin, what we're talking about there is your J-span number plus your liquidation period and large position add-on. This information is then available aggregated from the client up to the trading member or clearing member. And as I've said, it's updated. These numbers are updated then on the screen during the day as trading occurs or as new prices come into the RTC system. Then we've got some thresholds on these numbers. They're not hard limits, and that's why we're not using the word limit. It's a threshold that we set up, which you can just use to see if there is trading is happening and causing margin calls that you might not be wanting to have those exposures for. So we set up a threshold on the margin call of a client. And this threshold is then set up looking at to what extent your initial margin plus your additional margin plus your variation margin since the last margin call, since the last end of day, how that compares to the collateral that you've posted up to that point. And if that breaches a certain threshold that we've set up, that would then be highlighted. As I've said, it gets highlighted at this point, so we don't stop trading or anything like that. It just highlights the risk. And how this limit or this threshold gets set up is that the JSE sets up a threshold for the market as a whole, and then the clearing member and the trading member can adjust that threshold to be more conservative for their specific clients. Just looking quickly at how this monitoring would look. So at a client level, you can see here's all the different clients, and here we show the trading member for the client as well as the clearing member. And you can see the JSpan risk number, your liquidation period, large position, settlement margin. So all of these added together gives you your initial margin. Then you've got any additional margin that's calculated on that, plus the variation margin. Then there's the collateral that you've typically settled on the last margin call. And that difference is what your indicative call is up to that point. So these numbers would then be updating during the day. So you could be looking at if I don't trade anything more by the end of the day, this is typically what my margin call is going to be on the margin portion. So not taking into account any of the interest rate settlements and things not related to margin. And then obviously, like I said, you can also view these numbers aggregated to a trading member level as well as a clearing member level, depending on what your interest is at that point. So that's all I wanted to discuss on this specific item. We're going to have just a short break now because we're going to go into a bit more detail on specifically the margin calculations. So really, if that's not your interest, then you're welcome to leave at this point. Otherwise, we're going to continue on the margin calculation portion. Okay.
living the way we do, babe. Tell me why. When will we see the light? Peace begin. Here's the night. Baby, witnesses show you right. It don't take a genius to know right from wrong. It's been going on for too long. I can't take it, babe. We won't make it, babe. It'll take a stand to what we can to make a change. Will things change? Will it always be the same? Will things change? Will they remain the same? We can't just ignore all of the madness that's been done before. The problem still remains. Let's do more. They complain. We've been through so much pain. Let's not let it all get in vain. We should have learned from mistakes in the past. The senseless wars we've had should be our last, and find a better way to communicate before it gets too late. Let's join hands, do what we can to make a change. Will things change? Will it always be the same? Will things change? Will they remain the same? People's mopping, buildings burning, teachers teaching, no one's learning, children shooting, babies starving, love trifling, one's surviving, government is slowly dying, talk is cheap, one is trying, one is trying. Will things change? Will it always be the same? Will things change? Or will they remain the same? Will things change? Or will it always be the same? Will things change? Or will they remain the same?
Okay, looks like everyone's back. So what I'm going to do now is I'm going to give you just a run through some of how we do our margin calculation work, but maybe not a detail at the higher level, just to give you the framework. And then Paul will go into a bit more of a detail and show you an example of exactly how specifically JSpan gets rolled out. So let's quickly look at the margining approach, specifically under ITaC. So what we're working towards is to have a single margin run across all of our markets. So not to have them calculate the margin on one market separately and then add up everything right at the end. We do it as we go along. And this is really because that allows us, the JSE, to give offset where we deem it appropriate, even if it is across different markets. Now, obviously, for this to work, we are rolling out ITaC in certain phases. So as the new markets get onto ITaC, they will be included in this margining methodology. The markets still on the older system, STT, they use the existing margining framework. So as we go on going forward, the new ones will migrate to ITaC, and we'll get the single offset. And you can see, so our first one is equity derivatives and currency derivatives, which we're hoping to get onto RTC, probably middle of 2017. And then we've got the other markets, interest rate derivatives, commodities and cash equities, following thereafter. So our margin requirements, the main margin requirement is your initial margin, which is based on JSpan. For ITaC Go Live, we are implementing JSpan 99% as it is today, just with some minor tweaks to volatility skew and the VSR. We're implementing the liquidation period add-on, which would also be available on STT by then. And this is really to cater for large positions that will take longer to liquidate than was assumed under JSpan. And then we also have the lots exposure add-on, which cater for losses which could exceed the margin that we hold under JSpan and liquidation period add-on. Then at the later stage, we are planning to drop JSpan and go on to HISTVAR. And the reason for using HISTVAR is we believe it will be more intuitive to understand where the margin numbers are coming from. And it will be based on 1,000 returns with a stress period included in there on each of the underlyings on which the futures and the options are trading. And we will then adjust let's call it the base historical VAR number with a Vega risk and a calendar spread risk add-on. So it's similar to JSpan, but in the sense that these volatility adjusted returns today are currently already used in the IMR number that gets used in JSpan. So there's consistency in that regard. And then there's also your additional margin, which is also today already being used, which is then added to the initial margin. And that is based on whether the clearing member believes, or the trading member believes there needs to be additional margin on the client. Looking in terms of the replication of the numbers, we will be publishing a lot of information that you will then use with your own systems to replicate the margin numbers that you've just seen. Thinking back to the slides I did initially, which was the risk view, that is kind of where you're going to if you wanted to replicate all of these numbers. But if you weren't interested in that, then like we said, all of these numbers will also be available to you in their final form on the risk view. So on the website, that's where our more static data is published, updated between once a week and every second week. Here we've got your parameters for that, all of the parameters that go into JSpan. And typically we don't update these on a daily basis just to allow the market to remove some of the volatility of updating these numbers every day. Just prevents and makes it a bit more difficult for market participants to replicate the numbers. When we eventually go into historical value at risk, the return array will be on the website of the 1,000 returns, as well as some of the static reference data. On IDP, there's a number of numbers that we update daily: settlement prices, the rates, the JSpan risk arrays, the more dynamic instrument reference data, all of the parameters and data that gets used in liquidation period and large position add-on, as well as the P&L vectors for historical value at risk. And then apart from that, we also have the daily margin report, which is really a contract level breakdown of how all of these numbers get generated, the final risk numbers. So the idea really there is that if you do have all of the inputs to the risk numbers, but you're still not getting the same numbers as we do, then you can request the daily margin report, which we can then on an ad hoc basis make available to you. And I suspect that as we go live and as we go through testing, a lot of this will typically be used, the daily margin report, to make sure that you're using the correct portfolio, you're using the correct parameters. But once everything is working and you are replicating the numbers, there's not really a reason for you to need to use this report any further. So that's all from my side. I think Paul wants to take us through some of the detail on how would we actually take a position and generate the JSpan numbers on that, and where do we see all of those things pulling together. Paul? Is there any questions at this stage?
Thanks, Alana. I'm going to be going at a high level through what JSpan is and how it works. The intention is, so we've got a framework called JSpan, which is used to calculate initial margin at an account level. There's a spec on the web. That spec is really old and incredibly difficult to follow. So the intention here is to remove a bit of the ambiguity and make it as easy as possible, if you want to replicate JSpan, to do it from the steps I'm going to be demonstrating. So just to give you a high level.
Maybe just further to that, while the spec isn't probably, as Paul says, the most clearest document, we're obviously updating that, so that'll be available shortly.
So just a bit of background. So initial margin is collateral that is called for at an account level, and is supposed to cover the variation margin of a defaulting entity from the point of default to a point at which the portfolio is completely liquidated. So it's typically called a good faith deposit, right? It's there to protect the clearinghouse against someone defaulting and not being able to pay his variation margin payments. So account level initial margin is calculated by the JSE using JSpan. Clearing members can, however, so we don't take credit risk into consideration when we do JSpan at all. Every single client, if they've got the same position, will have exactly the same margin requirement. Clearing members can, however, apply credit risk on the individual clients and call for more margin that is called for under JSpan. And they would typically do that by having a JSpan multiplier. So, for example, 2. So a clearing member would say, I'm not happy with the credit risk of this client, so take whatever his JSpan requirement is and multiply that by 2, and that's the number that gets called for from the individual client. So before even starting to think of replicating JSpan, you've got to know what your actual credit risk multiplier is, because without that, you're going to be replicating a number that's going to be out by a factor of 1, 1.5, or 2. So I already mentioned we use JSpan as our account level. We currently use JSpan as our account level initial margin framework. And there's 4 parameters per tradable instrument or per futures contract that feed into JSpan. I'm going to be getting to those a little bit later, but we update those on a fortnightly basis. So every second week, we update these 4 parameters for every single contract. We give the market a week's lead time before we actually implement it. So today, for example, we're going to be publishing new JSpan parameters, and we're going to be saying to the market we're going to implement these next week, Monday. So a week in advance of them being in production, the market has sight of what these parameters are actually changing to. And I'm not going to be spending time at all in terms of going through how we calculate these parameters. They're calculated according to our own risk tolerance, and I'm just going to be focusing on how these parameters exactly feed into the JSpan framework. So before beginning with JSpan, there's a certain amount of reference data that you're going to need. So at a futures contract level, there's an example. There's the DEC 15 Aussie, so it's a DEC 15 future on the JSE Top 40 index. There's 3 fields you're going to have to need to be able to replicate JSpan. Those things called a CSG, which is a class spread group, which is going to get used to determine calendar spread initial margins. So for example, if you have a DEC Aussie versus a SEP Aussie, what exactly is your margin going to be? That's going to be determined by what class spread group that contract resides in. Then there's something called a series spread group. So we also give initial margin offsets for highly correlated but different contracts. So for example, the top 40 and the SWIX are part of the same series spread group called the equity index group. So if you go long a DEC 15 Aussie, you go short a DEC 15 DTOP, you're going to get some form of initial margin offset. And to be able to replicate that, you've got to know that both those instruments are part of the same series spread group. And then the final piece of reference data you're going to need is the contract size or contract multiplier, which for the Aussie contract is 10. So Rand per point is 10 Rand per index point for the Aussie future. And I'll show you exactly how that feeds into JSpan in a while. Then looking at the actual JSpan parameters, as I said earlier, there are 4. It's called an initial margin requirement, IMR. So that quite simply is the amount of initial margin you'd pay if you just had one position in a single futures contract. So for the Aussie, for example, it's about 30,000 Rand. That means if you go long 1 Aussie, your initial margin requirement is going to be about 30,000 Rand. If you go long 10 Aussies, your initial margin is going to be 10 times 30,000 Rand. Calendar spread margin requirement, that parameter is really only used to determine how much initial margin you pay when you do a calendar spread. So if you do a DEC Aussie versus a SEP Aussie. Series spread margin requirement is used to determine your initial margin on a series spread, so Aussie versus DTOP. And volatility scanning range is really only used to determine the initial margin you pay on an option. And I'll show you exactly how that parameter is used to determine the initial margin on an option. So to replicate JSpan, just to recap, you're going to need some reference data at the futures instrument level, and options will inherit the reference data of the future. You're going to need the JSpan parameters, and then on a daily basis, you're also going to need certain pricing data. And to be exact, the pricing data you'll need is the futures price, at the money volatilities, and the volatility surface for each and every instrument. So currently, as part of a end of day mark-to-market stats, we publish for each option the mark-to-market volatility as well as the premium. You're going to need more than that to do JSpan. You need the at-the-money volatility, so the volatility corresponding to the at-the-money strike, as well as the surface used to determine the mark-to-market volatility. So what I mean there is, if, for example, you've got a call option, a 55,000 call option on the Aussie, and the at-the-money strike is 50,000. In terms of moneyness, the strike's 50,000, at the money is 50. It's going to be 10%, 110% moneyness. So if you read off this skew for the surface, for the DEC 15, that's going to be 110%. So it's 55,000 divided by 50,000 gives you minus 3.3. So if a mark-to-market volatility on a 55,000 call option is going to be whatever the at-the-money vol is, minus 3.3. So we're going to be publishing in terms of a mark-to-market stats at the money minus 3.5. To do JSpan, you need this whole surface, because when we do the risk arrays, you're going to need this surface to replicate what the mark-to-market vol is going to be under each scenario. Okay, now, in terms of what the actual risk arrays are, so this first step in JSpan is for each tradable instrument, construct a risk array, which is just a vector of profit and loss scenarios for the particular contract under a series of futures price and volatility scenarios. So the exact set of scenarios are governed by two things. It's what we call a future scenario set. So that's determining the extent to which we're taking the futures price and bumping it up and down. A volatility scenario set, which is determining the extent to which we're taking at-the-money vols and bumping them up and down. And then a liquidation period assumption. So that just means for an option, we're revaluing the option for T plus something to see what the P&L is going to be on T plus something. So currently that something is 2 days. So we're revaluing the option for today plus 2 days under a set of vol and price scenarios. So here's at the bottom, we've just got an example of a future scenario set and a volatility scenario set and a liquidation period. So what that means, that -1 and that -1, that means we're going to be taking the futures price and bumping it down all the way by 1 IMR. So remember, the IMR is the initial margin requirement on an outright futures position. So for the Aussie, for example, the IMR is 30,000 Rand. If the Aussie is trading at 50,000 Rand and it's got a multiplier of 10, that means the notional exposure associated with one Aussie future is 500,000 Rand. IMR is 30,000 Rand. So one of these scenarios means we're going to be taking the notional exposure of the Aussie and bumping it down from 500,000 Rand to 470,000 Rand. That is one futures price scenario. Then a volatility scenario is at the same time we're saying, what if at the money vol stays constant? It does nothing. What's going to happen to the mark-to-market value of a specific contract under that particular scenario? So the future scenario set together with the volatility scenario set defines a risk array that looks something like this. So under this particular futures and volatility scenario set, it boils down to a risk array consisting of 27 scenarios. Scenario 1, for example, would be I take the futures price and I add -1 times the IMR. That's what I'm assuming is happening to the futures price. At the same time, I'm assuming my at-the-money volatility is going to go down by a full VSR. What is my mark-to-market value of my contract going to be if that scenario were to happen? And remember, I'm taking my at-the-money vol down by a full VSR, but I'm leaving the skew or the surface of which I'm marking unchanged. Scenario 2 is I take the futures mark-to-market and I bump it down by 75% of an IMR. I take my at-the-money vol and I bump it all the way down by a VSR and I revalue my contract under that scenario. Continuing in this fashion, I end up with 27 scenarios of P&Ls for each contract. Okay, so there's nine scenarios of my futures price changing by an IMR up, 9 down, and then there's a flat volatility as well. So we're going to be specifying, so the future scenario set, just to be clear, is going to be defined on a global level. So it's not going to be per instrument or per market or per segment. It's going to be everything that is cleared by JSE Clear going to be governed by the same future scenario set and volatility scenario set. And the actual risk arrays at a contract level, so something that looks a little bit like this for each tradable instrument, is going to be published daily on IDP. So for those guys that aren't interested in replicating the actual risk arrays, you can replicate account level IM by just downloading the risk arrays and doing all of the subsequent JSpan specs, JSpan steps. The problem with that approach, though, is if you're interested in seeing what the initial margin is going to be on a particular strike for an option that wasn't listed last night or tonight, you're not going to be able to do that because we're only going to be publishing the risk arrays for a set of instruments that are actually listed. So to be able to replicate what the margin is going to be on a strike that's not listed currently, you'd have to go and replicate the steps leading up to here from scratch. Is there any questions at this point? Okay. So going on from a contract level risk array. So at a contract level risk array, your initial margin is just going to be, so if you just had one position in a single contract, your initial margin would be the smallest element in the contract level risk array. So it would be the largest negative profit and loss at if you just had one contract. You then get a position level risk array by taking your position in a particular contract and just multiplying that by the contract level risk array. So if you had 10 contracts in the ALSI, you would just take all of the elements of the ALSI risk array, multiply it by 10, look at the minimum value in that array, and that would be your initial margin for 10 ALSIs. If you then go one step further and you can then go one step further and aggregate it at an expiry level. So at an expiry level, an ALSI, together with all of its options, are part of the same series spread group, or class spread group, sorry. And you aggregate at an expiry level and at a class spread group level. So if you had an ALSI, DEC 15 future, and a 55,000 call on the DEC 15 future, you would aggregate your position in those two contracts to get an expiry level risk array. So if those were your only two positions, you would take the minimum value of that aggregated risk array, and that would be your initial margin at your portfolio level. Okay, so it's perfectly offsetting at an expiry level. Okay, so now we've gone from a contract level risk array to a position level risk array to an expiry level risk array. Then there's only really two steps left. It's to determine the amount of offset you're going to get on calendar spreads, and also the initial margin offset you're going to get on series spreads. So calendar spreads are often the term used to refer to a position involving long and short positions in the same class spread group. So coming back to my example on the ALSI, it would be a DEC 15 ALSI versus a SEB 15 ALSI. That would be an example of a calendar spread. Now, JSPAN recognizes the risk-reducing impact of having a calendar spread. So if you were long ALSI, SEB, long DEC ALSI, short SEB ALSI, there's less risk in that position than if you were long SEB ALSI, long DEC ALSI. And JSPAN recognizes this by applying calendar spread margins. At a very high level, the way it does this is each contract has a calendar spread margin requirement called a CSMR. So what happens at a JSPAN level is it says, take the CSMR of my position that is long, add to that the CSMR of my position that is short, and add to that the difference between the two IMRs of individual contracts. So, for example, going back to the ALSI, if my DEC 15 and SEB 15 ALSIs both have an IMR of 30,000 Rand, this portion of the equation is going to be 0. If they each have a calendar spread margin of 4,000 Rand, this portion is going to be 4,000 plus 4,000, which is 8,000. So my total initial margin on a DEC 15, SEB 15 ALSI spread is going to be 8,000. If we didn't allow this, the initial margin would be 30,000 plus 30,000, which is 60,000. So there's a big offset benefit associated with introducing calendar spread margins. Then finally, we get series spread margins. So that is the example of ALSI versus DTOP. And again, at an instrument level, reference data, you'd have to know exactly which series spread group each instrument belongs to be able to account for series spread margins appropriately. So the logic is exactly the same as for calendar spread margins. It's taking the SSMR of the long position, adding to that the SSMR of the short position, and adding to that the difference between the individual IMRs. So going to ALSI DTOP, my ALSI has an IMR of about 30,000. DTOP has an IMR of about 8,000. So this term is going to go to 30,000 minus 8,000, which is about 22,000. And the ALSI has an SSMR of 9,000, DTOP 2,000, so that's 11,000. My total initial margin on a portfolio is going to be 11,000 plus 22,000, which is 33,000, which is less than I would be paying if there was no offset. Okay, so that's how we handle series spread margins. We've shown how to do calendar spread margins, how to do the risk arrays, and particularly take account of options in the risk array, which is typically, guys, trying to replicate JSpan from scratch, the biggest difficulty comes in replicating the account level or the instrument level risk arrays, particularly for options, and the problem there is most typically rounding. So as part of it, the spec Terence alluded to, which we are rewriting, we're going to be exactly specifying where to round and how to round so that there's no ambiguity with respect to that. Are there any questions? No. Calendar spread. Series spread to that. Cool, and I think that's it, guys. That's all from my side.
So, as Terence said, we will be updating the JSpan spec. In addition to that, Sandra and I might talk to it as well. We're planning to make ourselves available for individual sessions. So once you've been through the spec and through today's notes, if you have further questions, if you are software developers trying to replicate JSpan, there'll be that opportunity.
Yeah, and maybe just to finish that up also with where we're going, JSpan is what we're going to go live with. We're going to go live with what we have currently in Nucleus. That's the marginal methodology. That's not going to change. As to Paul said, there's some slight, very minor tweaks. But thereafter, we'll be going through to looking to go through to a histofile methodology, which will allow greater offset, but we'll be giving more detail around that as we get closer to that time, and through the various advisory committees, we'll be giving more detail, more technical detail that will allow for exact testing and the building of that from your side as well.
Thanks, guys. Just for the guys on the webinar, so we will be updating the JSpan specs, and I'll publish a service hotline as soon as they are updated and available on the web. Okay. Thank you for your time, and we will publish the agenda for November and hope to see you soon.